Today's podcast is brought to you by Cheeky, a line of bar-quality syrups and juices for the home. If you're someone who loves craft cocktails but does not love the work, Cheeky may be for you. Check out the core 8 flavors plus the newly released limited edition espresso syrup at cheekycocktails.co and enter the code Movers and Shakers at checkout for 10% off your first order.
Movers and Shakers, the podcast about people and ideas that are changing the beverage landscape. Now here's our host, April Wachtel.
Hey, movers and shakers. It's your host, April Wachtel, and I'm so excited to share today's interview with Andrew Merinoff. Andrew is the founder of DisPact Ventures, an investment fund focused on emerging retail, food and beverage, and technology brands, and is also the co-founder of Chinola Passionfruit Liqueur. Andrew's experience spans multiple sectors and industries, including F&B, wine and spirits, hospitality, investing, and marketing. In the podcast today, we discuss how Andrew thinks about failure, the biggest mistake entrepreneurs make, how to strategically set your spirits brand up for acquisition, and Andrew's advice for entrepreneurs raising capital in the current investing climate. I think you'll agree Andrew shared some incredible advice in today's interview, and I hope you enjoy the conversation as much as I did. Without further ado, please enjoy my interview with Andrew Merinoff. Andrew, thank you so much for joining me on the Movers and Shakers podcast. How are you today?
Hey, I'm fantastic, April. I really appreciate you having me on. I'm excited to be talking to you today.
Yeah, I'm so excited to talk to you. We've obviously had a couple conversations in the past, and you have such a wealth of experience in the beverage industry. I think our listeners are going to be really interested in what you have to say today. So let's just start out. I ask all my guests to just explain a little bit about how they got into food, beverage, and hospitality, and then we'll just take it from there.
Awesome. Sounds good to me. Well, as you mentioned, my name is Andrew Merinoff, and I'm the CEO and founder of DisPact Ventures. I think some would say I was born into the food and beverage space, coming back 4 generations. I was in my first kitchen at 6 years old, cracking eggs, to teaching the adult culinary class by 11, working for some of the top restaurateurs, like Be Our Guest restaurants by 15. And what I really realized is I wanted to learn all the disciplines. I wanted to know the front of house, the back of house, the marketing side. I wanted to know what it was like to be a dishwasher, a line cook. So I really put my time in throughout the years, from opening up restaurants to nightclubs, to working for the agencies that ran the liquor brands. And then I got into college and I was majoring in food and beverage and international business, which were my 2 really big hobbies. But I realized that I didn't really know much about the outside world outside of the food and beverage space. So I started something called Techquity, which, as you'll know, I like to play on names. So it's equity in tech companies. And that's really where we started to incubate and build small tech ventures. And it wasn't great at first. Bankrupted the first company with a small investment, failed on the second one, but I learned mistakes that I knew I never wanted to repeat. By the time I left college, we'd worked on about 25 different tech deals. And I thought, hey, I know the disciplines, I know the M&A space on this side. I'm ready to hop back into the food and beverage sector. So 25, I joined Proximo Spirits, which is owned by Jose Cuervo, working a little bit on their M&A and business development. And I spent the last seven and a half years there. And it was there where I really fell in love again with the spirit side of things. And that's how DisPact Ventures was evolved. The first brand in there was 7 Rooms, which I'm sure if you've made a restaurant reservation, it has said powered by them. And then on to Chinola. And today we have 17 portfolio companies, home bases in probably 11 countries, operating in over 60 around the world. So it's been quite an adventure, and throughout it, we've learned a lot. We've failed a lot, we succeeded a lot, and like I said, we've had a great time doing it.
Andrew, how old are you right now?
Yeah, so I just turned 31, so
Happy
getting
birthday.
up there. Thank you very much. Getting older. But like I said, I always knew that I wanted to work. Sitting at home, even on a Saturday, Sunday, is not very easy for me. My fiance will agree that I'm not good at just sitting still. And I love building things. I love helping other people build things. I think it's what really drives me.
Yeah. I mean, I think there's so many listeners who, again, most of our listeners are in food, beverage, hospitality. I would say primarily in beverage alcohol. And I think a lot of people would be wondering, how do you accomplish so much in such a short period of time? And how do you focus on a project and then also have your hands in these other things? So I'd love to get into that in just a couple minutes. Can we talk a little bit about your family history in beverage alcohol? Just let's delve a little deeper because it is so interesting. and pretty rare as far as the people I speak to anyway.
Yeah, no, we have quite the family legacy, and it really all started 5 generations ago on my mom's side with Hiram Walker. He was probably the original bootlegging gangster out in Canada in Walkerville. He is the founder of Canadian Club Whiskey. During Prohibition, was probably one of the biggest importers of whiskey into the U.S. And what's funny about him, unlike most, after being shot at by Al Capone and really rubbing hands with some real mobsters, it's funny because he was shipping whiskey over Lake Michigan. And the boats were destined for Cuba. Anyone with geography knowledge knew that was physically impossible. And that's how you know that bribery one that was taking place. But that was the cool side. And on my dad's side, it goes back 4 generations. My great grandpa started a distribution company and bootlegging during Prohibition. And the day after Prohibition ended, all of a sudden we were an established distributor here in the US. My great grandpa actually didn't go into business at first, went to Harvard, graduated second in his class in just 2 years, became the attorney general. And the funny thing about that is the joke is the first 12 people he put behind bars were my great grandpa's best friends. Immediately he says, puts an end to that. You have to come work with me. And then my dad eventually jumped into the business. So technically I'd be 4th generation on that side. My sister has her own distillery called Matchbook Distilling, where she is the master distiller out in Greenport, Long Island. And we've always had a little bit of a competitive nature, as I just finished Manhattan's first distillery in over 100 years called Great Jones. And we both started building at the same time, and she finished 3.5 years earlier than me. So very competitive in nature, and she won that one.
Got it. Got it. So you said Tequity was your first entrepreneurial venture, correct?
Yep, a few more throw-in events and whatnot, but that was the first established one.
Gotcha. Now, how did you decide to start that as your first business?
So to be fully transparent, I got to college with about 6,000 work hours of experience. In hospitality, you need to spend 1,500 hours working in front and back of house. And I got this term divine right thrown at me a lot. And divine right as in, oh, you only did it because who your family is. And what I said is, who with that divine work 6,000 hours for fun? It's something I love to do. And so I decided that if I was really going to establish myself outside of the industry and say I'm a powerhouse in the M&A side, do something that's so far out of my realm and knowledge. And tech was there. Woke up with a napkin one day saying Techquity. We had the first 2 ventures lined up and said, we're going to run with this. And we were able to help establish and build 25 plus companies, selling some to Fortune 500 companies before I even graduated college. And after winning Entrepreneur of the Year, my dad thought it was all just a party, have fun, and travel. And then I got a nice validation for it and decided I can probably turn that M&A side of things over to a space I know very well, which was obviously the wine and spirits side.
I'd love to hear about some things that you think did not work so well when you launched Tequity, because I think I speak to so many entrepreneurs who, first time entrepreneurs, feel the pressure to have a wild success as their first sort of experiment with entrepreneurship. And I think more and more people understand that to build a brand or to build a company, it's not just you go from 0 to 60 and it's a smooth sail. You have to fail a lot along the way. So would love to just understand a little bit more about some lessons you learned in those first few companies.
Yeah, I think success is dangerous because if you are successful in the beginning, you don't know how to lose. The failure gets bigger because the risk becomes larger. And I think there were a few big things that I made mistakes on. I was looking at a company with one of the best boards ever, the smartest people in the room. And the first thing my dad says is, Andrew, be careful. Smart people make dumb choices all the time. I really took that to heart. I started to understand that one of the biggest things you can do is have a very strong HR background and manage expectations. I don't think people's expectations are managed properly. I think people read these overnight success stories, but they're not overnight. People think Tito's is an overnight success story, but it's been on for 10, 11 generations, and he just figured out how to dial it in. And Tito Beverage, and yes, that's his last name, was just the first one to understand how to scale things and instead of going wider, going deeper. And the last thing is understand your core focus and solve one issue for everyone versus a little few minor issues for everyone at the same time.
Now, do you think, of course, failure is imminent for everyone at some point on their journey. No matter how long they avoid it, at some point it's going to happen, whether it's a huge failure or small failure. Do you think that it is completely unavoidable, or what decisions can budding entrepreneurs make to avoid some of the bigger mistakes?
Yeah, I think that comes in a few fronts. The idea of an entrepreneur means that you are setting out to do something new, different, and I guess not yet defined. So if you do not fail at all, it means you're probably not taking the right risks in order to expand the business. And failure doesn't mean you just did something wrong. Failure just means you might have done it in the wrong way. I believe that not every business needs 100% of what it takes. I think you need the right teams, the right ideas. But failure to me is just trial and error. I think trial and error is a better way to say failure. I am going to try a few things, see what sticks, and then hone in on that. I think an example for beverage entrepreneurs is they make an RTD with 5, 6 flavors. And then they figure out, oh, I can just add another 5 flavors and boost my top line revenue. That's not always the right case to do it because you're saturating the market further. And if you didn't get it right with the first 4 or 5 of them, you're probably not going to get it right with the next 7 of them. It also makes it a pain for your distributor. And that's what people really think. Distributors are there to build and grow your brand. They are the facilitator, the last mile to deliver it. I think people need to get boots on the ground. They need to understand the right marketing. And not all marketing works. In fact, I'd say 40% of our marketing is a complete bust, but we've measured the analytics. We understand the return on investment on it. And then we double down on the things that we know that work.
Would it be accurate to say then having a growth mindset and just understanding that it's an ever evolving process? Would that be accurate?
Yeah, it has to be an ever evolving process because if you keep the same ways, you end up being irrelevant. You become a dinosaur. I really think people need to try it. They need to understand it. Anyone can have an Excel file, but if you don't understand the basics of Excel, you're not going to know how to tweak certain numbers in order to accelerate your growth. So by using these new tools, and I love technology, but I think it has made us stupider, is because it does all these automated things for us. So sure, I can type all my numbers into an online program that will create my profit and loss statements, but then how do you tweak something because you don't understand it? It's generating numbers for you. So I think that's just a small example of understand your business, understand all capacities. And how I accelerated the way I did is I know, and I've stepped in the shoes of the dishwasher, the front of house barman, the maitre d', the line cook. So I know when there's an issue, how to fix it because I've been there with them.
Yeah, totally. So in my entrepreneurial journey, and I share tiny little tidbits of this from time to time on the podcast, I think probably one of the biggest moments for me was I had a business that didn't work, and then I had a business that did work. And I think it was so hard with the first version to understand what was going wrong because the only example I had was one that was just moving very slowly. And then once I got to one that was selling a lot better, I was like, oh, I should have thrown in the towel on that first idea like a million years ago. So I'm wondering, were there particular insights, whether it was with Tequity or later with DisPact, where the contrast of having something successful and something unsuccessful allowed you to kind of move forward at a faster pace?
Yeah, I learned something very smart early on, and that there is emotion and there is intelligence. When you are emotional about something, you're probably not as intelligent about it. When you're intelligent about something, you're probably not emotional. Entrepreneurs are very emotional. That is their baby, that is their kid. You need to know the day that you're supposed to drop the kid off at school or the day that this is the lost cause. And I think it's a really important lesson to say, here's where things are going wrong. Here's how I can pivot and fix them. Or guys, it's time to throw in the towel and move on to the next venture. I think a really smart thing people can do is surround themselves with really smart people. I have one saying where I don't ever want to be the smartest person in the room. If so, I built a bad room. I don't want to be around people that are not willing to learn. If you are set in your ways, you probably will never expand onto that. And I never let everyone agree with me in a room. Even if you agree with me, everyone has to play devil's advocate. Because if I'm in a room with 10 people and 9 are telling me yes, then 9 people are not needed in that room.
Yeah. Yeah, no, it's such an interesting point. So let's move on. Let's talk about Proximo a little bit if we can. So you are, what is your title again? It's Director of Business Development. It's something in biz dev.
Yeah, I wear a few hats there. When I first got over to Proximo with our CEO back then, he said, hey, we want to build a distillery in Manhattan, the first of its kind in 100 years since Prohibition. That is going to be your business development role. At the same time, we want you to do the M&A, so mergers and acquisitions role. And so basically, if we can't build it ourselves, let's go try to acquire it. Yeah. And so that's what I spent the last 7 years is building new projects. Some are still confidential, but you'll see opening over the next year. And the other part was how do we go hunt the next cool brands that fit into our portfolio? In order to know what fits in your portfolio, you have to know the portfolio very well. You have to understand all the ins and outs of it, from finance to legal to marketing, because then it works. If you don't know the company from the ins and outs of where you work, you're never going to be successful there. You need to know everyone's name. You need to know a little bit about their families. You need to understand, hey, if this tequila brand is brought in, this is going to work this one might not work because of the company culture that we have here, even though they're the same liquid. I think that was really important in my role at Proximo.
When you're talking about brands that fit, how do you assess that at like a very high level?
So I think it's looking at the Nielsen and global trends, understanding, hey, we are a powerhouse and we have a marketing budget. So if I was an independent, starting a tequila brand right now is really tough. But Cuervo, we're already so dialed into the tequila market that creating a new brand, distributing a new brand, like picking up Haha Tequila, we already have a sales team that understands tequila like the back of their hand. It is very impressive to hear them speak about it. Similar to whiskey, when we did the Proper 12 deal and Strain of Hands and Pendleton, those are all things that were very much in our wheelhouse. As an independent, you need to figure out a way that you do not go head to head with a Cuervo, Diageo of the world. But as a Cuervo, I'm going head with Diageo. And the trick is, how do I always one up them? I tell better stories, I build a better company culture, and I'm more knowledgeable.
So I'm wondering, given where you sit as somebody who invests in businesses, you've worked for strategics, you invest obviously with DisPact, and you're an entrepreneur yourself. I'm wondering if you think that there's a relationship between the size of an acquirer and the success of the acquisition. Size can be a huge advantage, and it can also be a huge disadvantage due to nimbleness, having quarterly results that you have to show to shareholders if you're a public company, et cetera. So to tie up the question, do you think that there's a relationship between the size of an acquirer and the success of the acquisition?
Yeah, absolutely. I think when you look at the companies of scale, look at an AB InBev and there's 8,000 employees that work almost specifically on the M&A side of things, you get lost in translation. There's a lot of red tape and it is very difficult for them to move fast, but they're the powerhouse because once you're in their system, you scale very quickly if they pay attention to you. I think there are other companies where you know every single employee there, you can move quickly, but they do not have the same scale and power. So I think there is a big point there. And quarterly earnings are painful. These companies have to be buying things, they have to improve top line revenue, but at the same time, they don't know capital's gains. They're getting all this capital in, they need to deploy it. And sometimes that is not the greatest thing for them because they deploy things in a timely manner. And you want to reverse engineer that. I want to buy things that work for me because they work for me and not because they have to work for me. And I think that can sometimes be a big miss there. I think the second part of it and what entrepreneurs need to be careful of is know who your buyer is and when to sell. Because occasionally when you're worth $400, $500, $600 million, there's no one left there to buy you because no one wants to go to that scale. They're going to buy the person at 300 and then they're going to outgrow it very quickly. So always hold on to things as long as you can operate them. But the second you're ready to turn them over, probably go back 3 months and go for acquisition then, because you need to leave meat on the bone is what I like to call it. If there's nothing left for the supplier to then build off of, you are not valuable to them. But if they know the second they plug you into their channels, they can grow this brand by 30, 40, 50%, if not more, then you're a very real value there. And I think some people miss that.
That's so interesting. So you're saying, how does an entrepreneur figure that out? Exactly. I mean, again, I think it's just be smart, like know your business. But if you're not ready, knowing that you're going to be ready in 3 months, I mean, you may not know with that degree of accuracy and specificity.
I think that's where you get really good advisors who have been on the other side of the table that understand what the business is. And I think here's a really important one. A lot of people are chasing these national accounts, the Marriotts, the Publix, et cetera, and they try to grow because it's going to hit them a certain case value. What they need to start doing is growing intelligently. And when if I get Marriott's 5,000 hotels to agree to take my product in, and I'm at 20,000 cases trying to get to 100, I would say no. But if I'm at 70,000 cases trying to get to 100,000 cases, yes, bring it on. You're probably going to get me halfway there. And honestly, I'd probably get towards the end of that deal. And this sounds crazy, but get to the end of negotiating a really big powerhouse deal like that, then go to a supplier and say, hey, by the way, I have this deal in the pipeline. It is going to increase my sales 20%. I am going to hand you this deal. You will give me the value, but right off the bat, you can take credit for growing this business 20% in the first 3 months of owning it. And so there are small tricks like that that I think make a lot of sense and can add true value. But like I said, there's emotion, there's intelligence. And why I say build a really smart room of advisors and board of directors around you is they tend to have less emotion and more intelligence. And then if you build advisoryship, make sure to listen to them. A lot of people will put the people in a room to not listen to them. And I think that's almost anticlimactic to what the goal is.
Yeah, totally. I love, by the way, that advice. I have a lot of these conversations. This is the first time I've heard that specific recommendation, and I love it. I think it's super smart. I have a question, and by the way, all of this is off schedule. So I apologize for totally taking this conversation in a direction that I had not intended to.
No
But
problem at all.
so something I've been thinking about a lot is, again, I'm not sure how relevant this is to all of the brands that you work with, given that so many are beverage alcohol. There's less D2C, obviously. But many of us know, I think it was last year, iOS changes with privacy on the iPhone. This changed the game for brands being able to target their customers and accurately know their customer acquisition cost, among other things. I've seen a lot of brands that have built themselves up almost entirely on paid marketing, where they're just paying for eyeballs, and then obviously being able to convert customers really effectively. I have personally had a lot of disbelief that a brand built that way will have the longevity and, I think, clause in the affections of the consumer as much as a brand that is built a bit more organically through true word of mouth referral. Now, obviously, when you have a million more eyeballs or 100,000 more eyeballs, obviously word will travel faster than if you don't pay and you have 1,000 eyeballs. But I'm wondering if you think that I'm totally off base here, or if you think that there's something there, because we've seen so many of these brands scale super huge, privacy changes affect the way you can target, and then all of a sudden they are really struggling. And the momentum is just not carried after they lost that sort of magical paid advertising ability. Thoughts?
I think it's a great question, a great point, and something I have to drill into my founders all the time. There is organic growth and there is inorganic growth. And by spending all this money on marketing, you're not building a real loyalty, you're building one-time customers. And I'd love to see the conversion rate. I'd love to see the repeat orders. That's not the way to do it. The real way to do this is, at least for me in the spirits game, is something called liquid to lips. Get people to try your product, get people to fall in love with it, and tell your story in a genuine way. There are companies spending millions and millions of dollars. They throw it to a marketing agency, but as an acquirer of those brands, within about 5 hours of due diligence, I can tell how strong loyal your following is versus how much you pay to gain those followers. In fact, Chinola, the Passionfruit Liqueur that I'm the co-founder of, we probably spent $30,000 on marketing in a year that we grew 450%. This year, we'll buy more assets, actual tangible assets, like our Frio bar cart to make snow cones with. We will put boots on the ground to start doing samplings and put a humanistic touch to things. But these companies that are just trying to get eyeballs on it, to your point, all of a sudden, iOS changes and your whole following, your whole model is done, and the growth isn't no longer organic. See, people think the race is to $20 million, $30 million in revenue in 2 years and you're valuable. No, you do it slowly, you do it correctly, you build the right following that is a very loyal following. You build what I like to call a brand evangelist, someone that goes around telling your story for you.
Yeah.
That to me is the most successful thing you can possibly do, because anyone can go raise $8 million and spend all on marketing, but can you do the same thing with $2 million, smaller budget, and then do it at a reasonable way that adds value 3 years, 5 years from now? And I think that's really what big suppliers are looking for.
Yeah. I don't know if some of this attitude about like high growth, grow huge, just like 0 to 60 in 2 seconds. I don't know if that came with, the start of venture capital in the 70s, or if it's something that people just like to see a success story that's just like mind-bogglingly fast, or what it is exactly. But I do feel like a lot of entrepreneurs are misled by that and think it's not as much of a success if you build it over 5 years or build it over 10 years, or if you're not crushing the game in 2 years, you're not going to eventually accumulate that volume and that rate of sale and all of that. So anyway, I'm glad to hear your perspective on it, because it feels not real,
Yeah, I think the easiest piece of advice I could possibly give to any entrepreneur is build your company to be profitable and to give out a dividend check. Do not chase top line revenue to go to be acquired. Anytime an entrepreneur comes to me at DisPact Ventures or Cuervo and I say, what are your goals? And they say to exit in 4 years like Casamigos, I leave the room. What I love when founders come to me and say is, Andrew, in 3 years, 4 years from now, I'm going to give you $10,000, 5,000. It could be minimal, but I'm going to actually give you a dividend check from this company. And I ask, where do you see this company in 10 years? And they say, listen, Andrew, if we do really well, we would love to keep it. If someone comes with the right acquisition deal, we would like to sell it. But I'm building this for longevity. See, if you build to be sold, you're going to build incorrectly. If you build to have a sustainable company, you're going to be bought before you even realize it. I think that's the biggest miss entrepreneurs make, is they always chase this Casamigo story, but there's a lot more to that story that people do not know about how that brand was built, the agave futures that they held, the celebrity endorsements behind it, the actual earn out payout. People hear $1 billion and now they want to drink the $1 billion tequila, but it's fooling people and it's making a lot of these companies crash and burn because they're chasing the wrong thing.
Yeah, totally. Yeah, I think I probably was exposed to that concept of you can grow yourself out of business maybe like 5 years ago or something. But that notion too, I think, again, especially first time entrepreneurs, or honestly, even if you're just an experienced entrepreneur, but maybe you don't have your head in the details as much as you should, that actually can happen, I would say, relatively easily if you're not careful, where you're just chasing growth, and all of a sudden you just don't have money to fund it and you're scrambling. And then again, things can happen like the current fundraising climate right now, which is, it's a lot harder than it was even a year ago.
Yeah, no, like I said, I think it's the biggest mistake that people can make. And you should look at your P&L and see it in the green in 3 years, not just burning cash every single day for the sake of growing top line revenue. I think those days are done. I think people were going back in the trend of, hey, if that's what you're going to do as a big supplier, I'll just do the same thing. I'll survive though, because I have the cash flow to do it. And like I said, I think the best thing you can possibly do is grow the business to maybe make it a single business for you for the next 20, 30 years. And by the time people see that sustainability, and it might happen in 2 years, 5 years, you're then valuable to them.
Yeah. Yeah. Love it. So let's talk about DisPact a little bit. If you want to just do a quick intro to the fund.
Similar to Tequity, I like to play on words. So DisPact was all about disruption of industry with impact investing. And the real idea behind it is not to find another tequila, gin, vodka. It was to find brands that are doing innovative items. Coconut Cartel, the first rum cut with real coconut water. Chinola, the world's first shelf-stable fresh fruit liqueur. Empirical Spirits, using negative vacuum purge distilling. I would love to explain that to you if I really understood the full nuances of it. I just knew I went to Copenhagen, fell in love with the team there, and they had a really solid concept idea. So the portfolio companies I was really going for were breaking the norm, not things that I was going to try to scale up and that $100, $200 million buyout, but companies that all worked in synergies together. 7Rooms, now understanding what people drink, how they go out, how they dine. Pinata being the first real-time sampling platform to get data analytics. And I don't want to explain data analytics, but not understanding data is probably the most detrimental thing you can do to your company, because it is the most important asset you might have that you don't know about. And so really a lot of the companies I was building tapped into those resources, understood the playing field, but all disruptive and quirky in their own way.
So I think every entrepreneur would say my business is disruptive. Like unless you're just like plumbing, or something very like fundamental. How do you discern between things that are disruptive and innovative versus the rest of the noise?
Yeah, so I think there's this sense of craft and there's a sense of things at scale. I think the idea is, and Chinola is my best example for this. When I launched Chinola, it wasn't to go after the other two big passionfruit liqueurs. I went after the puree business. I was the closest thing to a puree with alcohol in it. I was shelf stable, and it was a very sizable market. And my distributors did not mind because I was not kicking some of the other brands off of shelf. In fact, I was kicking the puree companies out of the bar, which they didn't support anyway, so they were all for it. I think that was a really key thing. I think Coconut Cartel was amazing because it was very disruptive in the sense of no flavoring, no additives, using real coconut water. I think the second part of this disruption is telling a real story. The difference between a $30 bottle of wine and a $3,000 bottle of wine isn't $2,970. It's the story that they've told behind that bottle of grape juice. And I know that will offend a lot of winemakers, and it'll make a lot of other ones proud because they tell the right story. The other thing about impact investing at its highest meaning means doing something that is socially or environmentally responsible. So my brands, I like to pay fair wages. I like to support the local economies of which we go do business with. and build with us together to grow a stronger brand presence and something that they're going to be proud of. So I think that's the big disconnect and something that we find very true to our core function at DisPact Ventures.
So you've obviously spoken about a little bit about the thesis when you said impact investing. So it's sort of it's not industry agnostic. Obviously, it's food, beverage, hospitality, but it's not necessarily a specific brand. It can also be technology. Like for you, it's innovative within its own space, not strictly like a beverage brand.
Yeah, why my advisors and people want to kill me on a regular basis is because I go across sectors like nothing else. I have been in tech, I've been in food and beverage. I love to blend the two together. We dabbled in cannabis technology, we dabbled in the beauty space. I do not raise funds in the normal sense where I raise a big fund and everyone comes in and then I have advisors that tell me what I have to do. I do everything as an SPV deal, which means if a company needs $1 million, I say, hey, I'm going to help you raise 500,000. DisPact comes in for a portion, and then I tailor the investors for each deal to that specific company. So I think that raising capital, to your point, a year, 2 years ago was easy. Raising strategic capital was very difficult. Now raising capital in general is very difficult, but making sure you're taking money from the right people that can help accelerate you. And it's not just a spirits person. Go find a packaging person, go find a logistics person, a marketing person, a data person. Get those small checks in and then say, hey, I just need 10 hours of your time per year to help me re-envision this. Because these guys they'll help you in logistics, and nothing like getting your cogs down from some guy that teaches you how to ship something better.
Right. Right. So so I'd love to talk a little bit about white space. I think we've obviously seen this absolute gold rush with RTDs and the like, sort of convenience items that deliver refreshment. My personal perspective is all the big guys are going to crush almost all the little guys. So I don't understand why so many people are chasing this thing. And we also don't know the timeline of this thing. We don't know how long it's going to, stay in extreme growth for. So how do you think about white space? Are you thinking about it on a very long-term basis? Are you thinking about, I could capitalize on this thing right now? I think I know the answer, but would love to hear in your words.
So I think you just made a great point. Before, I'd say 10, 15 years ago, there were 700 breweries and maybe 1,000 distilleries in the US. We have now over 9,000 craft breweries in the US and over 20 or 2,000 distilleries. And the big brands, the Jack Daniels of the world, aren't mad about their other competitors. They're mad about the small person that wins in each hometown they have. Thousands of RTDs now, they're not winning across the US, they're winning in small markets and they're knocking other people off shelf. It is really hard to find white space in a place that is so saturated across the board. So instead, people now want to know what they're putting into their bodies. They are willing to pay a premium for that. Look at your ingredient list, make sure it is healthy, it is beneficial to you. I think that's the big trade up. The second trade up is premiumization. People are willing to pay a little bit more for something that they knew came from someone that was paid fairly, done in a sustainable way, and that might benefit the world as a whole. That is our next generation of people. So not trying to create a new category, really honing on your ingredients, the premiumization of those ingredients, still making it affordable, and then understanding who you're chasing, who your competitive set is, and where you can try to take them down. Because to your point, the big guys aren't worried about a big brand coming in. They're worried about the 3,000 small ones that are eating their appetizer, not their lunch.
Right. So do you think that the era of large brand dominating, launching and dominating, like large new brand, not legacy brand, launching and dominating is over, and it's going to be an increasing fragmentation across beverage alcohol?
It's funny. Every 5 to 10 years, I think the big guys switch. First, they buy everything. Then they go to those entrepreneurs that started something, they bring them in-house and they develop them greenfield. Then they go back to buying things. And it is a wild trend that we have seen quite a bit. I can't say that the domination of big players is over. If you look at Proper 12 at Proximo, one of the fastest growing Irish whiskeys in the world, but then you also look like an independent like Screwball, came out of left field, came and took out everyone. Aviation Gin, as an independent, although really good financial backers, really good playbook they had there, came out and really helped win the race. So I think the big guys still have a few tricks up their sleeve. I think they're slow to adjust. I think what people are realizing is you don't need 30 flavors of vodka. You probably need to do three really well. And if you look at a brand like Kettle One doing the botanicals and everyone's switching, the trend will be sustainable. It will be high functioning, et cetera. And I think the big guys will always understand how to bring things into market. It's will that brand be around in 5, 10 years from now if they launch it? And that's not always the case. They get it wrong all the time as well.
Sure. Let's transition to thoughts about investing in general. Is there anything that you would change about the structure of investment, whether it be, again, in venture capital, whether it be about the way strategics invest? Is there anything that you would change knowing what you know from the entrepreneurial perspective?
Yeah, it's a tricky question. I think that strategics know how strategic they actually are. And as simple as that sounds, it can be very tough. I think the issue, and not from the investment side, more the taking in cash, is people see a dangling object that's shiny and they get pressured back into a corner and they take it. I think investors need to be careful about not being overly abusive, making sure the valuation is very correct. I think that's the thing that we miss quite a bit, is getting our valuations right. There's something called a down round. And what a down round means is if you say are valued at $30 million and then the next raise you're valued at 20 because you couldn't get anyone to invest in a higher rate, is really detrimental to a company. And I think that there's actually investors that put companies into that place. And it's a very bad one and a tough one to get out of. I think managing expectations on valuation and not looking at the $14,000 case multiple Casamigos got, I think that's a misconception right now. And investors like myself not buying into that, because it's not the entrepreneur's fault for making high valuations. It's the investors telling people this is what your company is worth. And it's a slippery slope. And I think you're going to see that come crashing down in the next 2-3 years. Of people have to understand companies are only worth what they're generating.
Got it. What about advice for entrepreneurs raising capital? Obviously, you have so much experience again on both sides. I would say advice in two ways: general advice, and then advice right now, given the current climate.
So I think it kind of stems off what I just said. There's three key things they can do to raise capital. First, go into the meeting and don't mention Casamigos. Please don't do it. Please manage expectations and understand you're better off giving a realistic valuation, because strategic will invest in a realistic valuation. If it's so far of left field and you're under a $3 million a year revenue run rate, manage the expectation correctly and make sure you're valuing the company correctly, because you're going to get much better investors. And I always say, I prefer to have less of something that's going to be great than more of something that's going to be mediocre. And by that, if you think your company is worth 20 times top line revenue, you are incorrect until you are at a scale that is breaking 30, 40,000 9-liter cases a year or the equivalent of that. So I think that's the first thing people can really do to help that. And the second one is look at your profit and loss statement and figure out where's equilibrium. Where are you going to hit a balance point that you are actually profitable in? And people want to know that there is a route to actually be able to make money one day. I think 5 years ago, that wasn't as important. In our next climate coming, people need to understand in 23, 24, things might get really tough there for a while. The liquor industry isn't always affected. People tend to just trade down a bit, but being conscious that you need to be able to hold money tight. And what you don't want to become is a fundraising company. And by that I mean not raising enough cash where you have to go 12 months later just to raise more cash. I think understanding when you say use of funds and you say, I'm going to just hire this really senior guy who's going to grow us, you might not be ready for that really senior guy. The trick is hire slow, fire fast, and put that in your game plan. I think people will make that mistake if they get $6 million and make sure that pie chart you have doesn't say 65% or more of marketing dollars, because that is not the right way to spend the money. People will look at that as lighting on fire, and it's not always an approach that strategic investors want to see.
Love it. Andrew, what other recommendations do you have for our listeners, or do you have anything else you want to share that we did not discuss?
Yeah, I think, like I said, one of the most important things people can do, and I'll list it from my priority, is don't oversaturate your own brand. And by that I mean, do not add more than 4 SKUs when you bring something to market if you're going to go through distribution. If you're going direct to consumer, it's a different story. You can fill your website up with a ton of different products, which is totally fine. But understand what your core competencies are and get ready that you might have to shoot 1 or 2 things that you thought were great, know by reading the data. The second part is please make sure to manage expectations, not only of yourself, but of your other employees. is the most important thing that you can do is have realistic goals and expectations. Shoot for the stars, but understand here's the right trajectory, here's the right projection. And what we talked on earlier was do not go spend millions of dollars on some marketing campaign before you have hit, a 10 to $15 million run rate, because that will never lead to organic growth 3 years from now. And if you're not acquired by then, you will go decline. So I think there's a bunch of things that we covered today that I think are very important. Like I said, surround yourself with more intelligent people than yourself, and you'll always be successful.
Yeah. Love it. Andrew, where can people find you, DisPact Ventures, and then Chinola?
Absolutely. Well, I'd love for you to come check me out on LinkedIn. Chinola right now is covered in 26 states across the US and about 13 different countries right now. We are ranked as the fastest growing cordial in the US by Nielsen and outpacing a lot of fun brands. And then please reach out to me on Instagram at Hey Merinoff. Love to have a conversation. Love meeting fellow entrepreneurs. And if nothing else, you'll probably find me out and about in the market doing what I call brand research, which normally happens at a bar.
Perfect. Andrew, thank you so much for your time today and have a wonderful rest of your day.
Absolutely, April. Thank you so much for having me and look forward to seeing you soon.
Thank you for listening to Movers and Shakers. Follow us on all social media at Movers S Shakers.